Hello and welcome to episode 5 of the Retirement Readiness webinar series. My name is David Vigil. I am the president of Vigil Wealth Services, an independent financial planning firm. And tonight, or today, wherever you're located in the world, we're going to be discussing annuities, or I'm going to be discussing annuities and what they are. There's many varying opinions on annuities. I'm going to try to keep it as basic as possible. And have a second webinar where we get a little more in depth with the annuities. So, with that said, an annuity. An annuity is a contract between you and an insurance company that either they're going to pay you income now or in the future. So, there are immediate annuities, and then there's deferred annuities. And what an immediate annuity is, it means just that. You get income within 30 days after the contract is signed and approved, and you start getting income. Now, the income is based on the premium you give the insurance company, and they have a withdrawal rate. And if they are called an exclusion ratio, which again, I'll go into greater detail in the more complex on episode 6. So again, there's an immediate and a deferred annuity. An immediate annuity just means that you start taking income 30 days after the contract being established. There's different types of immediate annuities. There could be a set time frame where it pays out, or you can take just life. So you live 20 more years, congratulations, you get more of a payout. You live 3 months, it's null and void after you pass. There's also set times where you can do a 10-year period certain, life with 10-year period certain. So no matter what happens, that insurance company has to pay you for 10 years. And if you pass within that 10 years, your beneficiaries, they will continue to get payments until the end of the 10 years. So a deferred annuity, that just means it's deferred. You don't take income right away. You defer it to sometime in the future. You may never take income, or you may take income 3, 4, 5, 15, 20 years down the road, depending on how the contract is established. So what are the types of deferred annuities? There's the fixed annuities, which if you go into any bank or credit union, they're going to talk to you about because those interest rates are pretty good right now, which just means that it's fixed for a time frame. You have a fixed interest rate. After what's called the surrender period, you can take the funds out without a penalty, which again, I'll get into surrender charges on the next meeting. And there's 1 year, 2 year, 3 year, 5, 4, 5, all the way up to 10 years on deferred fixed annuities. Very simple. There's no fee for the annuity. It is a fixed rate for the fixed term. There's also, if you take money out prior to 59.5 on any annuity, depending on how, again, I'll get more complex and we'll talk about the 2T distributions, but rule of thumb is if you're taking gains out before 59.5, you will be subject to income tax and the 10% penalty on top of that, just like an IRA. So again, deferred fixed annuity, again, very simple, no fee, fixed rate, fixed term. To the end of the term, it can roll over to another term depending on how the annuity is structured. Then there's indexed annuities. What that means is they are tied to a particular index. And just to keep it simple, because there's now 50 to 100 different indexes out there, if not more, let's just talk about the S&P 500, for example. It's when you're watching the news or the financial news, they're talking about the stock market. They're generally talking about the NASDAQ, the Dow, or the S&P 500. So an index, again, it's tied to the index, the S&P 500. And again, there's a time frame. Generally, that's 5 years and more. But you can participate up to either a cap or participation rate, which I'll explain what those mean in English now. So it could be a cap from point A to point B. So June 21st, 2023, the S&P, for example, is at 4,000. It's higher than that today, but let's say 4,000. June 21st, 2024, it's at 5,000. But you're capped at, let's say, 5%. You would participate up to the 5%. Okay. June 21st, 2024 to June 21st, 2025, let's say it drops 25. The S&P drops 2,500. It's a big drop. You don't lose anything, but you don't make anything either. You had no interest credit for that year. In the next year, your high water mark is 2,500. So each year it does that. It resets itself from point A to point B. And again, there's several indexes. I'm just using the more popular one above the S&P 500. Again, it's deferred annuity. And again, it's tied to an index. You participate either to a cap or participation rate. A participation rate means, let's say that index says 10% for simple math, and you have a 80% participation rate. 80% of 10%, you would get 8% for that year for an interest credit. So no downside risk, no fee for majority of those, unless you have a rider, which I'll go into detail with on our next episode 6 about riders. So again, fixed term, fixed rate, very vanilla. Don't want to say it's a CD because it's not FDIC insured. None of the annuities are, no matter what the person you talk to at the bank or credit union says. The index, again, is tied to a particular index, and you either have a cap or a participation rate. Then you have registered index, RILAs. I wish we knew what the L means. Registered index annuities. Why am I blanking on the L? Anyway, so a RILA. What a RILA is again, it's tied to an index. It's, again, for simplicity, it's the S&P 500, and you could have a greater cap or a higher participation rate, even over 100% participation rate, depending on the insurance company. And all the annuities, again, are issued by insurance companies. Banks don't issue them. It's all issued by insurance companies. So again, a RILA, but again, there could be some downside risk to a RILA. They may have a 10% buffer. That means in English is that, again, from June 21st, 2023 to June 21st, 2024, if the S&P 500 drops 15% and you have a 10% buffer, you'd be down 5. So the first two, no risk of principal, fixed index, and then you have the RILA, which is in between, right? Because you can have some protection, but you have greater caps historically on a RILA. So again, some are uncapped, some may have caps of 12, 13, 14% for the year, if not higher. But again, your principal will be at risk. And there's different time frames. You can do a 1-year segment, a 3-year segment, or a 6-year segment. Most of the RILAs, again, for simplicity, there are liquid RILAs, but for this particular webinar, the majority of them are 5 to 6 year terms, where within that time frame, you can only take out either 10% or the interest credit, depending on the insurance company, during that time frame. If you take out more than that, they will, again, you'll get a surrender charge. And also, if you're below 59.5, you will be taxed on the growth up to 10%. Okay. That RILA is going to bug me. Registered index linked annuity. I knew it would come to me. A RILA is a registered index linked annuity. And again, it's linked to an index. So there could be a 10%, there could be a 20% buffer, there could be 100% principal protection, but the cap will be lower. So there's all different ways you can structure a RILA, and it all depends on, as always, your goals and your risk tolerance. So you got, again, the fixed for monies that you want to keep extremely safe. You get a fixed rate, fixed term, no fee, none of that. Index, again, fixed term, could be 5, could be 6, 7, if not longer. Where it's tied to the index, you have a cap or participation rate depending on the contract. And each year you can change that around on, if you do a 1-year segment, you could move from the S&P to another index with a different cap, different participation, to your advisor about where the caps are and what you should do. A RILA, again, same thing, but your principal will be at risk. There are RILAs with no fees, and there's RILAs with fees. As you can probably guess, with the fee, you're going to get a higher either participation rate or a cap. Okay, so the last one is a variable annuity. What a variable annuity is, it's essentially an investment portfolio inside of an annuity contract. So you, inside of a variable annuity, you have sub-accounts where you can invest in different mutual funds, different index options, whatever's on the platform for that particular insurance carrier. With a variable annuity, though, there is higher fees. So there's what's called the mortality and expense ratio. That's what you pay on just for the insurance on an annual basis. But again, if you're looking to invest your money and you want to get some tax deferral, and again, all annuities, their interest and growth is tax deferred until you take it out, and then it's taxed as ordinary income. So again, if you want to participate in the market, don't want to pay taxes on capital gains or dividends, interest, whatever the case may be, you can look at a variable annuity. All of these products, excluding the immediate annuity, you can add what's called a rider, where you can get income from it. I won't go into the riders today. I'll go into greater detail at the next meeting. Just know and keep in the back of your mind, a rider is essentially an additional, it could then be an additional fee that can give you a guaranteed lifetime income stream, okay? Or give you a guaranteed death benefit. So there's living benefits and there's death benefits inside an insurance annuity contracts, which I'll go over those again the next meeting. Okay, so what are the costs? Again, these are questions that I wrote up myself. These are the questions I get for existing clients or prospects that come when we discuss annuities. Are annuities for everybody? Probably not. Do they make sense for certain folks who are looking for a guarantee? Absolutely. But again, go back to your goal, speak with your advisor and make sure it matches up. Because the last thing you want to do is be an annuity and you're going to be taking income, but then you realize, well, I don't need this. Now I got to set it fit. If I'm in a variable annuity, I'm paying fees every year. So again, make sure you go in detail with the advisor. So the cost of the different annuities. The immediate annuity generally doesn't have a cost associated with it. It's just the payback for a certain period of time. And there are folks who use those, again, because they want an income stream. They don't know what the market's going to do. They want a guaranteed income stream for their life or 10, 15, 20 years, whatever the case may be. Different payouts for the different options, life, 10-year period, certain 15. Again, when you speak to an advisor, make sure they print out the different options and again, you make the right decision. The fixed annuity, if it doesn't have a rider, doesn't have a fee. The only fee is the time constraint. You have to keep it for 1, 2, 3, 4, 5 years. But again, if it matches your goal and it's an interest rate you're comfortable with, and you either within an IRA or non-IRA, and you want some tax deferral, there you go. The index, again, same thing, fixed index annuity. Generally doesn't have a fee if there's no rider attached to it. And again, the rider is if you were electing for a living benefit or a death benefit, which I'll go into greater detail in the next meeting. Variable annuity, that comes with costs because again, anytime you're investing in sub-accounts, mutual funds, there's management fees, there's mortality expense, and that could range anywhere from 1% to 1.25% for the M&E, and then you have the fund expenses could be 50 to 1%, 50 basis points to 1%. So all in, you could be paying 1.5 to 2.5%, depending on the annuity. And again, if you have a rider, there's an additional fee on top of that. So, and I'll go over those again. So what are living and death benefit riders? I wrote that question down. Don't think I want to get into it because again, I want to just go over the very, very basics of an annuity so you understand. At our next meeting, when I'm start saying the terminology fixed annuity with rider, fixed annuity with or index annuity with the cap, our participation rate, you'll know what I'm talking about. So what are some do's and don'ts pertaining to annuities? The do is always match it up to your goal. If your goal is you need the money in 3 years, you don't want to do more than a 3-year product, right? If the goal is I want an income stream, I'm whatever age I am and I want an income stream to last me the rest of my life, you can look at immediate annuity. That could be the highest immediate payout. And in a deferred annuity, again, we'll get to the riders, it can grow if you don't touch it over time to potentially get you more income, which I'll give you examples at the next meeting. So don'ts are, again, get into annuity not reading the fine print. You don't want to get in there and 2 years down the road, you go, you know what, I need my money back. And they go, okay, we'll send you a check, but we're going to take 7% of your principal because you have a surrender charge. And again, a surrender charge is in all the annuities unless it's what's called a C-share. And again, I'll go over in that greater detail. So it could be 1 year for a fixed annuity, 2 year, 3 year, 4, 5, all the way to 10 years. Index product, what I've seen, the minimum is 5 years, goes 6, 7, and again, up to 10. Variable annuity, if it's not a liquid share class, you're looking at least 6 years. surrender, if not 7. So you can take some provisions. Most of them will give you either 10% of the annual value, which you can take out penalty free, okay? Or you can take out the interest. So there's, again, make sure whoever you're working with, they print out the fact sheet or the report where you can see withdrawal provisions. And there are other provisions if you're terminally ill or you're in a, if it does have it, if you're in a nursing home where you can access the principal up to a certain percentage without a surrender charge. But again, make sure you have that discussion with your advisor, your planner. So real quick and dirty on the retirement readiness episode 5 about annuities. What are annuities? It's basically an insurance contract between you and the insurance company to either pay you income now or pay you income later. And it could be, again, where you just lump sum it after the surrender. You pay taxes on any of the interest that's credited to it. As long as you're up to 15.5, there's no 10% penalty, and you go about your business. There's many, many more ins and outs of annuities, but again, I'm going to save that for the next episode where I go into greater detail about riders, living benefits, death benefits, what they look like, what income, what type of income stream, how long, and all that good stuff you can expect. So it's just me on this one. Fortunately, my co-host didn't make it. But again, my name's David. I am the president of Visual Wealth Services. I hope this was informative. And if you have any questions, please don't hesitate to reach out via my website, visualwealthservices.com, or my email address, david@visualwealthservices.com. So thank you for joining and have a fantastic night.